Welcome to Tech Money Madness, your daily U.S. stock market deep dive. Today is July 3rd, 2026, and we're diving into the daily market briefing to really cut through all the noise out there.
Yeah, there is a lot of noise today.
There really is. So, to start, I want you to picture a car, right? The digital dashboard is just absolutely glowing. The speedometer is maxed out. The lights are flashing green, but underneath the hood, the physical engine is just completely sputtering out.
Oh, man. I know that feeling.
Right. You pull over, you pop the hood, and you realize half the engine blocks are just missing. And I feel like today we are looking at a market where certain tech sectors are surging by like 800%, even as the U.S. labor force hits a 50-year low.
Yeah, it's a massive fracture. The economy is literally splitting in two directions.
Exactly. So our mission today is to build a roadmap for you, the listener, to navigate this fractured market. We'll start with the macro economy, hit some wild headlines from politics to space, and then jump into this massive divide between AI and traditional tech.
Sounds like a plan.
Okay, let's unpack this, because looking at this briefing, how is it possible for a market to hit these astronomical valuations when the foundational workforce is shrinking so drastically?
Well, it really forces us to rethink what actually drives market optimism, We normally assume that a booming stock market equals a booming, fully employed economy.
Right, that's the traditional logic.
Exactly. But the latest jobs report just completely shatters that assumption. We're seeing a really marked decrease in hiring across the board.
Yeah.
But the data point causing the biggest shockwave is the labor force participation rate. I mean, it has fallen to its lowest level in half a century, assuming we exclude the massive anomaly of the COVID lockdowns, of course.
Wait, a 50-year low?
Yeah, a 50-year low.
That means we are looking at baseline workforce data that rivals, what, the mid-1970s?
Basically, yes.
So what is the actual mechanism driving that? The briefing notes that job seekers are simply giving up on finding employment, but what does giving up actually look like in the raw data?
I mean, that's a vital distinction to make. The standard unemployment rate, the headline number you always see, that only measures people who don't have a job and are actively looking for one.
Okay.
But the labor force participation rate measures everyone who could realistically work. So when someone gives up, maybe their specific skills are just no longer relevant, or the cost of commuting suddenly outweighs the wage they stop looking.
They just drop out.
Exactly. They exit the labor pool entirely.
Correct.
So the government no longer counts them as unemployed. They're just gone from the system.
Wow.
And that actively shrinks the productive capacity of the entire economy.
Okay, so if the labor pool is shrinking and the economy is visibly cooling down, why isn't Wall Street in full-blown panic mode right now? I mean, the major indexes are seeing a wild mix of fluctuations, sure, but we aren't seeing a total crash.
If we connect this to the bigger picture, a sputtering economic engine fundamentally alters monetary policy expectations.
Right.
The market doesn't just react to today's news. It reacts to what the central bank is going to do about tomorrow's news. Because hiring is decreasing, investors look at this cooling data and they immediately scale back their bets on the central bank raising interest rates. High interest rates are essentially the brakes used to stop an overheated economy. So if the economy is already stalling out on its own, the threat of higher rates just vanishes.
So bad news for the everyday worker actually becomes this strange kind of relief for the investor because cheaper borrowing might be on the horizon.
Yeah, exactly. It's counterintuitive, but that's how it plays out.
And that expectation shift triggers completely different asset classes. Like the briefing notes that gold prices are set for their first weekly rise in an entire month. Why is gold suddenly the winner of a bad jobs report?
Well, it all comes down to yield. Gold is a non-yielding asset, right? It just sits in a vault. It doesn't pay you a quarterly dividend, doesn't pay interest like a government bond does. So when interest rates are high, bonds are incredibly attractive because they pay you a guaranteed high return.
So gold looks terrible by comparison.
Exactly. But the moment investors read the tea leaves of a dismal jobs report and assume interest rates are going to drop, well, those bonds become less attractive. Suddenly, that gold sitting in a vault becomes a much more appealing safe haven.
The mechanics of that are just fascinating. The labor market stalls, the threat of rate hikes drops, and capital just floods into a heavy metal.
Yeah, capital always finds the path of least resistance.
But the economy isn't just driven by spreadsheet formulas and rate expectations, It's deeply sensitive to executive power and the political landscape.
Well, absolutely.
And the briefing today leads with this crazy intersection of politics and business. President Donald Trump recently gave an interview with CNBC.
Yeah, that's right. And the primary focus of his commentary was a defense of his family's business operations.
Right, and he also discussed potential conflicts of interest regarding those operations. Now, keeping this strictly from a market perspective, we're not taking sides here, but when a political figure's private enterprise makes the top of the daily financial briefing, how does the market digest that kind of executive commentary?
The market mostly digests it as a leading indicator for corporate governance and the regulatory environment.
Interesting.
Yeah, investors are constantly monitoring how political figures navigate their own business ties. It often signals the broader approach an administration might take toward corporate oversight or deregulation or even antitrust enforcement.
Because capital hates uncertainty.
Exactly. Capital hates uncertainty. So any public interview detailing the intersection of executive politics and private enterprise, that becomes essential viewing for risk analysts.
Which perfectly brings us to the ultimate intersection of private enterprise and federal power today. Here's where it gets really interesting. We have SpaceX officially completing its Reckley IPO.
A massive milestone for them.
Huge. But the daily briefing specifically highlights the first known congressional stock buys of SpaceX. And this is happening at the exact same time the company is deepening its role in federal contracting.
Yeah, this represents a massive strategic pivot for the federal government.
Yeah.
I mean, historically, agencies like NASA, they built their own rockets.
Right. The Apollo days.
Exactly.
Yeah.
Now, they are completely outsourcing that innovation to private commercial space ventures. They are buying the service rather than building the infrastructure themselves.
It is a massive transfer of public reliance onto a private corporation. But the juxtaposition in this briefing is almost absurd to me.
How so?
Well, on one page, we have congressional buys of commercial spaceflight reaching these literal astronomical highs. And then on the very next page, the briefing warns of an extreme heat wave here in the U.S. that is threatening to completely overwhelm our terrestrial power grids.
Oh, yeah.
It's potentially disrupting July 4th travel. Like, we are outsourcing the cosmos, but we are terrified the lights might go out during a summer heat wave.
It's wild, right? It really highlights a severe duality in American infrastructure. We have these hyper-advanced, heavily capitalized new frontiers operating right alongside aging, fragile legacy systems.
And speaking of legacy systems trying to keep pace, Ford is prominently featured today, too.
Yes, they are.
CEO Jim Farley has achieved a major quality milestone, and the company is publicly targeting flawless new vehicle launches. Now, on its face, a 100-year-old automaker celebrating a flawless launch sounds like they're just doing the bare minimum of basic manufacturing, you know? Why is this a headline?
Well, because in today's auto industry, a truly flawless launch is incredibly rare and highly prized.
Really?
Yeah, I mean, vehicles are no longer just mechanical engines. They're basically rolling computers with millions of lines of code, insane battery supply chains, complex sensors.
Right, they're gadgets now.
Exactly. So what this shows is a fundamental shift in what the market rewards.
Yeah.
You have SpaceX, a company famous for its rapid, explosive iteration, literally blowing up rockets to learn how to fly, now maturing into these stable federal contracts. And meanwhile, Ford is publicly anchoring its value to old-school fundamental quality control. The market is signaling that whether you are in low Earth orbit or on a Michigan assembly line, flawless execution is the only metric that matters right now.
Execution is exactly what is fracturing the tech sector today. I mean, the idea that you can just buy a broad tech ETF and ride a monolithic wave that's totally dead.
Oh, completely dead.
We are looking at an absolute bloodbath on one side and a gold rush on the other. The divide between next-gen AI and traditional consumer hardware is just gaping.
What's fascinating here is we are seeing a sector literally cannibalizing its own supply chain.
Let's look at the gold rush first. So Micron Technology is listed as a top gainer today, alongside NVIDIA. Micron has surged over 800% in the past year based on Q3 earnings that completely shattered analyst expectations.
Yeah, 800% is just staggering.
Right. Now, everyone knows NVIDIA is the poster child for AI, but why is Micron rocketing up 800%? What is the mechanism there?
To understand Micron, you really have to understand the bottleneck of artificial intelligence.
Okay, lay it on me.
So AI doesn't run on traditional CPUs. A CPU acts like a single manager doing one complex task at a time. AI runs on GPUs, graphics processing units.
Which NVIDIA makes.
Right. And GPUs act like an army of thousands of workers doing simple tasks simultaneously. NVIDIA designs the army.
Got it.
But that army needs immediate, lightning-fast access to data to function. That is where Micron comes in. They manufacture the specialized high-bandwidth memory chips that feed the data to those GPUs. Without Micron's memory, NVIDIA's chips basically starve.
Wow, okay, so they are literally the picks and shovels of the AI data center build-out.
Precisely.
And the space infrastructure is getting just as ruthlessly competitive. We mentioned SpaceX's Starlink earlier, but the briefing notes, Amazon is officially escalating the satellite wars today.
Yeah, the Alio wars are heating up.
They've deployed enough satellites to launch their own LEO service later this year, setting up direct head-to-head competition with Starlink.
Yeah, and for clarity for the listeners, LEO stands for Low Earth Orbit.
Unlike traditional satellites that sit tens of thousands of miles away in geosynchronous orbit, LEO satellites orbit much, much closer to the Earth.
So what's the advantage of that?
The mechanism here is latency. Because the signal doesn't have to travel as far, the internet connection is incredibly fast and responsive.
Ah, I see.
So Amazon is engaging in this massive capital expenditure war to build a parallel space infrastructure, controlling global low-latency internet access from orbit that is the next monopoly frontier.
So the companies building orbital internet and AI memory bottlenecks are just soaring.
It's like high.
But the traditional tech giants are staggering. Like Meta is listed among the top losers today. Intel, this massive legacy chip maker, fell 9% in a single day, wiping out a huge chunk of the 270% surge they saw earlier in the year.
Yeah, Intel had a rough day.
But the one I am really confused by is Apple. Apple fell 6% today. And the briefing says they announced device price increases specifically due to rising memory and storage costs.
Yeah, that caught a lot of people off guard.
Wait, I'm confused. Apple is a multi-trillion-dollar titan. They historically dictate terms to everyone. Why are they dropping 6% because of memory costs? Can't they just squeeze their suppliers?
Historically, yes, absolutely. But Apple is running into the exact AI bottleneck we just discussed.
Oh, really?
Yeah. Apple builds consumer hardware. To make their new phones capable of running on-device AI, they need massive amounts of advanced memory.
And Micron makes that memory.
Exactly. But Micron and the other memory suppliers have total pricing power right now because the entire global tech sector is desperate for their chips. The supplier finally has the leverage over Apple.
Wow. So we are witnessing a direct wealth transfer from the consumer hardware giants to the foundational memory and GPU makers.
That is exactly what's happening.
Apple is forced to pay a premium to Micron, their margins get completely squeezed, and their only move is to hike the price of the iPhone.
And the market is looking at that price hike and heavily discounting Apple stock.
Makes sense.
I mean, investors are asking a very simple macroeconomic question here. In an economy where the labor force participation rate is at a 50-year low and where job seekers are giving up, are everyday consumers actually going to pay a massive premium for a new phone?
And the 6% drop in Apple's stock suggests Wall Street is highly skeptical of that.
Very skeptical.
It is a ruthless environment right now. If you aren't the AI bottleneck, you are being squeezed by it. And Intel's 9% drop reflects a similar harsh reality, right?
For sure.
They missed out on the hyper-specific AI GPU wave that NVIDIA captured, and now they are just collateral damage in a broader sell-off of legacy chips.
It's tough out there for legacy hardware.
But this pressure isn't just contained to Silicon Valley. To really understand today's briefing, we have to see how these structural shifts are forcing other legacy industries to completely rebuild themselves.
Yeah, the data points on finance and healthcare really show how these technological and administrative transitions hit the ground level.
Let's start with finance. We are seeing a definitive, aggressive shift toward digital payments today. Legacy companies like American Express and Chase are moving massive resources into the digital space.
They have to.
And this isn't just updating an app interface, right? This feels like trying to replace the plumbing in a 100-story skyscraper without turning off the water to any of the tenants.
I mean, that is an excellent way to conceptualize it. Digital payments used to be this, tech sector novelty. Now they are the fundamental rails of modern commerce.
Yeah.
Legacy banks have a massive advantage, though. They already possess millions of deeply entrenched consumers.
True, they have the user base.
But their back-end systems are often decades old. So if they don't rip out that old plumbing and modernize their infrastructure to match the frictionless instant settlement speeds of a digital-first tech company, well, those consumer bases will abandon them.
It is an existential pivot for them.
Completely existential.
And we are seeing an equally massive shift at the policy level in healthcare today. The briefing notes that Affordable Care Act, or ACA, marketplace enrollment, has declined by 3 million people. Now, the Trump administration points to fraud controls as the specific reason for this decline. But how does the mechanism of fraud control actually boot 3 million people out of the marketplace?
It really comes down to tightening the administrative safety nets. When an administration prioritizes fraud reduction, they implement much stricter identity verification hurdles.
Okay.
They use algorithmic audits of income reporting, and they enforce tighter grace periods for documentation.
So it's a lot more paperwork.
Exactly. If an enrollee fails to respond to a mailed notice requesting proof of income within, say, a specific 30-day window, or if an algorithm flags a discrepancy in their tax history, they're just automatically unenrolled.
Wow. So it's not necessarily 3 million bad actors, it's 3 million people caught in a much tighter, more aggressive administrative filter.
Yes.
How does a sudden drop of that magnitude impact the broader healthcare market?
It fundamentally alters the insurance risk pools.
Okay, how so?
Insurance relies on a delicate balance, right? Healthy people subsidizing the care of sick people. If strict administrative controls boot 3 million people, insurers have to scramble to figure out who actually left.
Right.
If the people who got kicked off for missing paperwork were primarily young, healthy people, well, the remaining risk pool just got significantly older and sicker.
Oh, I see.
And that forces insurance providers to drastically alter their revenue projections and potentially raise premiums across the board for the following year.
So what does this all mean? We have legacy banks ripping out their structural plumbing to survive the digital payment era. We have massive healthcare risk pools being rewritten by tightened administrative algorithms. We have consumer tech titans like Apple being financially squeezed by their own memory suppliers. If I'm trying to synthesize all these disparate threads, where does it leave us?
This raises an important question about who ultimately absorbs the friction of a changing economy.
Okay, what do you mean?
If you look closely at the underlying mechanisms today, the common denominator is always the consumer. If you are trying to navigate a newly overhauled digital banking platform, you are absorbing that friction. If memory chip costs skyrocket because of the AI boom, you are the one paying the premium on the new device.
Right, the 6% Apple drop.
Exactly. And if fraud controls tighten the ACA marketplace, you are the one navigating the complex new verification hurdles or facing altered premium.
An everyday person is just the ultimate shock absorber for all these structural transitions.
The market is ruthlessly efficient at shifting the costs of innovation and the costs of inflation directly onto the end user.
Wow. Let's quickly synthesize the core takeaways from this briefing for you guys. We are navigating an economy that is flashing major warning signs on hiring, right? With a workforce participation rate shrinking to levels we haven't seen in 50 years.
Yep.
We are looking at a stock market where the concept of tech has completely fractured. Next-gen AI memory suppliers like Micron are dictating terms and basically taxing the rest of the industry, while traditional giants like Apple and Intel are paying the price.
A total shift in power.
And we are seeing massive structural pivots everywhere, from Amazon's low Earth orbit satellite wars against SpaceX to legacy banks desperately trying to become digital payment hubs.
It is a market defined by extreme contrast today. Unprecedented technological wealth creation is happening concurrently with a fundamental hollowing out of the traditional labor force.
Which brings me to a final thought I want to leave you with today. We talked extensively about the U.S. extreme heat wave threatening to completely overwhelm our aging, fragile power grid.
Like the summer travel disruptions.
Yeah. And we spent a lot of time dissecting the massive, unchecked explosion of the AI sector driven by NVDA and Micron. Here is the thread to pull on that connects both of those things. Artificial intelligence data centers require exponentially more electricity to cool and operate than traditional computing.
They run incredibly hot.
Exactly. So if this historic AI bull market continues to rapidly build out its physical infrastructure to meet this insatiable demand, are we on a collision course where the digital ambitions of Silicon Valley will physically break the aging terrestrial power grid we rely on just to keep our lights on?
That is a fascinating tension.
Yeah,
And we are building a limitless virtual world, but it demands very real physical power.
Something for you to ponder the next time you look at a glowing stock dashboard. Thank you for joining us for this deep dive into the daily briefing. Stay curious, keep questioning the mechanics behind the headlines, and we will catch you next time.